Hey guys, welcome to the Investors Podcast new YouTube mini series where I'll break down our ultimate guide to stock investing to teach you the best tactics for building wealth over time. Hi, I'm Shawn, and this channel is all about the principles of investing. From stock tips to iconic billionaires, the best strategies, and our favorite tools, the Investors Podcast has everything you need to know. In this second video, we'll explore how to pick stocks like Warren Buffett and his mentor, Benjamin Graham, different types of investment accounts, and determining how much you should be investing. Getting started is often the hardest part in investing, as stocks may invoke flashy Wall Street depictions that just seem daunting. However, with this series, you'll learn what's necessary to not just beat the pros, but how to build a better financial future. You might find it surprising to learn that your investment performance will typically correlate less with your mastery of financial markets and more so with merely sticking to a principled plan over time. All right, let's get started. For those not sold on passive investing strategy, or those who seek to combine both passive index funds with their own picks, let's run through the basics. The key to effective investing is purchasing stock below its intrinsic value. If a company is worth $20 per share and you buy it for $15, well, you received a 25% discount, and the larger the discount, the higher your margin of safety, which hedges your risk of being wrong and reduces your potential losses. Always remember that price is what you pay, while the intrinsic value is what you get. As a shareholder, you're entitled to the company's equity value. So once all of the company's debts are paid off, whatever is left belongs to you at a value proportional to your ownership share. If the company's equity is worth $100 and you hold one share out of 100, well, you're entitled to $1. But that doesn't mean the shares are only worth $1, because that company isn't likely to just sell all of its assets today. Rather, companies seek to continue operating profitably so that equity value will continue to rise in the future. This means that the intrinsic value actually equals the current equity value plus the expected future increases in equity value discounted to today. The reason those future increases, also known as cash flows to equity, are discounted is due to the time value of money. A dollar today is worth more than a dollar in a year from now, partially because of inflation and also because you could invest a dollar to have more than a dollar. And the discount rate is a degree to which you complete this reconciliation by converting future dollars into a value relevant to you in the present. Wall Street may seem distant, and stock tickers may look like only letters on a screen, but the principles are the same as going out tomorrow and buying a local business or even an apartment to rent out. If you buy a McDonald's franchise, you're not going to be concerned by the daily and even hour-to-hour price that you could then sell it for. Warren Buffett personifies this irrationality through a salesman he calls Mr. Market, who comes to your door every day offering a different price for stocks despite the underlying businesses mostly staying unchanged. Rather than reacting with alarm to the prices that Mr. Market quotes, use low offers as a chance to buy your favorite businesses at a discount. Treat your stocks like businesses you want to keep over many years and ignore hysterical financial media and speculators. And good businesses to own will have a strong competitive moat, or in other words, their X factor in beating out competition. Coca-Cola's secret formula and devout customer loyalty is an excellent example of this principle. If a stock has no clear competitive advantage, you shouldn't own it, plain and simple. Another key idea here to know in stock investing is your circle of competence. To beat Wall Street, you have to ask yourself, what does Wall Street not understand as well as I do? If the answer is nothing, then stick to index funds. Whatever your background is, be honest with yourself though about whether you have any unique knowledge or expertise, and if you do, focus on exploiting it. This is what it means to invest within your circle of competence, and you'd be wise not to stray too far from it. So let's lay out 4 tangible rules to follow from none other than the legendary Benjamin Graham, who authored the famous book, The Intelligent Investor, and mentored Warren Buffett. Here are his 4 rules. First, diversify your portfolio between at least 10 to 30 stocks. This rule warns against not having all of your money in a few stocks, while also suggesting it's having too many, given the difficulty of properly vetting and tracking them. The second rule is to filter for large companies with low amounts of debt. And the third rule says to find companies with long records of consistent dividend payments, preferably 20 plus years. These two rules emphasize companies that are proven, for these businesses will be the best stewards of your money. If a company is at risk of not paying off its debt, well, you're at risk as a shareholder. And maybe the dividend rule here seems extreme or outdated, but remember that the point is to invest, not gamble. Decades of dividend growth and payment are a clear indicator of a company's lasting success and profitability. And the last rule is to find stocks that aren't too expensive. Look for bargain companies with a price to earnings ratio less than 25. This ratio captures the underlying income relative to a current share price. So a higher ratio indicates you're paying more money per share for a dollar of the stock's net income than you would for one with a lower ratio. At a PE of 25, this means you're paying $25 per share for $1 of net income, so a lower ratio is typically desirable. PE ratios can be found easily and are calculated for stocks with positive net income through sources like Google Finance and Yahoo. There are various types of accounts you could use to invest in stocks with varying benefits. The standard ones here are called taxable brokerage accounts, which offer no special tax or retirement benefits like a 401k, but it will allow you to freely invest in a wide selection of stocks and other securities. Charles Schwab and Fidelity are excellent full-service brokers for this that'll give you tremendous flexibility in picking your investments or sourcing their advisors for support. Robinhood offers more limited advisory services, but provides a full spectrum of potential investments at your fingertips with a simple user experience. And other beginner-friendly brokers like Acorns or M1 Finance are very useful for automatic contributions while removing all the stress of investment picking with pre-built portfolios. Like 401ks and IRAs, as we discussed in the last video, there are other accounts that can provide unique advantages, such as 529 plans and health savings accounts, also called HSAs. 529 plans facilitate saving for college and offer tax-free gains and withdrawals so long as they're used for qualifying education expenses, and HSAs offer savings towards medical expenses not covered by high deductible plans with no taxes on contributions, gains, and withdrawals for eligible expenses. These can be complex, so make sure to do your research or read the section on this in our investing guide. So which investment account should you open? The type of account you open will vary depending on your current place in life and expected future needs. If you're still on a parent's healthcare plan, you probably can ignore HSAs, but perhaps you should be funneling your savings into an IRA or 401k. If you're a new parent, you'll likely want to set up a 529 plan to contribute to in your child's name. Make sure though to consult a financial advisor for more information relative to your unique situation. So how much should you be investing then generally? The simple answer is to invest as much as you can, as frequently as you can, in the accounts or areas that provide the most direct financial and personal benefit. In asking how much to invest, review your budget and see how much you can contribute daily, weekly, or monthly. IRAs and taxable brokerage accounts will have the best flexibility for this, but in most accounts, there's some degree of discretion in determining your contribution frequency. Reflect on your current situation, intermediate and long-term goals, adjust as needed, and contribute accordingly. A good principle, no matter which type of account it goes into, is never to invest more than you can afford to lose. In any given year or several year period, one stock holdings could lose over 50%. This is something to take seriously. Don't be the foolish person who expects to get rich overnight from stock investing and ultimately quits when this fails to happen. A great strategy to hedge against our propensity for greed and fear is known as dollar cost averaging. Dollar cost averaging investments refers to frequent small contributions over time rather than putting all of your investable money in at once. For example, if you receive a $10,000 end of year bonus and want to invest, ignoring taxes, you could spread that investment out over 5 months with $1,000 contributions every 2 weeks to an index fund. The primary advantage is that you smooth out your investing journey, which may make it easier to stay invested for longer. That's it for this video, guys. Thanks for watching, and let us know down in the comments below what you learned. What type of investment accounts do you use, and what rules do you follow for stock picking? Just a reminder, nothing in this video is financial advice, and this is just intended for entertainment purposes. If you want to read our full guide to investing, check out the links below, and make sure to watch our book review videos covering our lessons from some of the best books on business and life. All right, see you all in the next video. With an investment selected, you can then specify the number of shares you'd like to purchase, or if your broker offers fractional shares, you can just input the dollar amount you'd like to invest.